Google explanation, basically in very simple terms, it's just defining any kind of strategy and then use it on historical data. So on the pricing data and the data for the last 1 year, 2 years, just go have an algorithm or something, go through it, and then say, you would have made this and that much money with it. It's actually, as I said, like simple concept, but interestingly enough, a lot of traders are not doing it. It makes intuitively sense to just have a look at what your strategy would have performed. And yeah, one of the reasons I think like people do not do it is that there's like very, very little frameworks that actually exist that are good. There's like, for people with coding experience, like Quantopian is a platform where you can basically code your own trading algorithm, and it's then backtested, and if you actually have a good algorithm, you can even enter a hedge fund. But the problem with that is it's very difficult to set up offline, and it's very difficult to use your own data, especially crypto, so it's like not the perfect solution for us. Especially if you want to communicate your results and have people, retry it. Other stuff is like tradingview.com, where you can basically click through every data point and then try to predict stuff. It's basically like backtest done by hand, where you just go through every day, for example, and say, okay, now it's going to go up, and it isn't, or something like that. So yeah. The problem with that is, of course, it's like very biased, because people tend to overestimate. Like even when they see the result, they say, okay, I would probably have understood that, or would have probably predicted that. So there's a lot of hindsight bias within it. So yeah, a lot of problems. Why do we use it in Santiment? Well, basically, we're different ways. We're a data provider, and we also like to communicate like insights about the data, about the crypto data. And there's different ways how you can communicate it. Basically, you can do purely descriptive stuff that a lot of news sites just do, just Bitcoin's gone down. Very simple stuff. There's description of single events that you could do, where you go basically very deep in a few single events and tell them what happened there. But the problem with that, of course, is also that people who want to tell you something about a specific event, about a few specific events, they want to sell at a certain point, and they're going to look for a very specific situation. So they're obviously also biased. And of course, you can also do like the gold standard would be some really in-depth statistical modeling that you can also do, that we are also doing. But the problem here is often like these models return stuff like R-squared, p-values and all that. And that is something that like hedge fund people, a lot of statisticians understand, of course. And but we also want to communicate to the regular trader, and so basically that's also like, yeah, not the best way to communicate it a lot of the time. We also do it, but we wanted to give some results in terms of really how much money could you have made using this and that strategy over that period of time. Yeah, so basically this is what it boils down to. It just gives you an approximate number of like how much money could I have made using a certain strategy. Basically, like what if I used, like for example, the previous one where you basically like every time Bitcoin has risen 5 times in a row, that would be an indicator for like a bull market basically, or some kind of upwards trend. You would then try to use that as a trading decision. What we're doing basically, as of right now, we're programming all our backtests ourselves. Whenever we publish something, whenever we publish an article, we also like give out the notebooks, the Python notebooks, so the source code for the backtest, so you can look at it yourself, you can download it, you can use it. What I'm working on right now is like some kind of small, flexible Python module, where you can basically use it to very quick and dirty do some backtests on data that you have. That hopefully should make it way easier. And like for the non-coding people, we're also working on Google Sheets plugin, basically, where you can just download it, and it'll be able to just very easily download data from our service, basically. And with that Google plugin, we'll also like publish certain like different examples of how to apply it, and certain versions of how to do backtesting within Excel spreadsheets, basically. So it's like the core concept of backtesting is really not that complicated, and can be like for simple models can be done within like a simple spreadsheet. So it's actually not so complicated to do. This is an example of how the module that I'm building right now is going to do it. So it's actually like even if you include the first 2 lines of importing, it's basically just 6 lines of code. So it's actually very easily done. And within these 6 lines of code, you download the data, you define the model, and you backtest it. And it gives you something like this, where the blue line is your portfolio control basically, and the red line, the orange line is Bitcoin. So yeah, you would actually in this case not perform so bad. You would turn like $1,000 into $1,467. Another different example is just one more line of code where we additionally download some other data from our platform. It's basically the GitHub activity, meaning all cryptocurrencies, or almost all cryptocurrencies, have some kind of are somewhat open source, and they typically have their code, all their code on GitHub, and we can basically look at it and measure like how much activity is going on there, how much are they developing. And like if you include that, very simple, just add this, you definitely perform even better, or you would have performed even better with, interestingly, the maximum drawdown. That's a metric of like the worst you could perform. Like if you bought at the highest point and sold at the lowest point, in this case you would only be able to lose a maximum of 11%, while in this case do 50% profit, which is quite impressive. Some examples of what we're doing more like full portfolios and testing them. In this case, we were looking at also the GitHub activity, and basically see like going through all of our EC20 projects, 700 plus projects, and then go through all of them, exclude low volume projects, and basically then invest every month in the projects with the largest GitHub activity. Of course, going for the previous month, you would always look at the GitHub activity on the previous month to decide for the current month, because you don't want any kind of, it's called look ahead bias. You don't want to look into the future basically, because you're looking at past data, and your trading decisions should always not be influenced by the current day, for example, but only by past data. And if you look at this, the orange is our portfolio. It's actually quite interesting. So this is not the perfect trading strategy, of course, but it's actually quite interesting to see that it moves very close to Ethereum as a benchmark in this case, because we're using ERC20 tokens only. But it moves way stronger. It seems to have like a lot more movement for every movement than that Ethereum does. And so we were actually looking at the beta, and it actually moves. The beta is a measure of how strong it moves, and it actually does move pretty strong. So this could be like, for example, an idea of leveraging. So for every percent Ethereum does, you would move like 1.5% or something like that. So you move stronger, and if you combine that with the previous, like this strategy was just a simple moving average strategy. So like the last 10 days, for every day you look at the last 10 days price change, and on average, if that one is positive, that would indicate some kind of upwards trend, and you would invest. If you would have combined that with this, for example, you could have probably earned some interesting results.
Jan, very shortly, GitHub? For the non-coders here?
GitHub is basically like the platform where for programmers to cooperatively code on large projects. That's basically the idea, and it's been like a common thing for that basically every crypto project is on GitHub open source, more or less. Like Ripple, for example, so obviously does not want to be published.
Can I ask a question?
Yeah, sure.
You show a couple of backtesting ideas. I'm sure you have a lot of others that you tried or in your mind. Mm-hmm. Do some of these ideas make you money? Are they positive cash flow?
We're not so far that we're actually investing or anything. But I mean, we've looked at some different strategies, and there's actually some interesting stuff that we found. Like this already could be something interesting if you're going for some kind of leveraged movement plus some kind of moving average strategy. It's not highly complicated. It's not like a deep recurrent neural network that you're training, but it is actually could be something in there. So it's the combination. But we don't actually do trading on our own. We're not a hedge fund, not yet, as far as I know. And so we don't really do trading.
On the other side, maybe we are positioning ourselves like a Bloomberg for crypto, where we draw the line not to run into conflict of interest. Well, we do invest ourselves like personally, I myself too from time to time. But our platform is only to give you, be it a hedge fund or sometimes news publication, media, high quality, timely data. Okay? And if it's for fund managers or for crypto funds, this is one of the tools for them to use. One-stop shop. But to become ourselves a hedge fund, so we will limit ourselves, and we will start closing the data, not giving you the most valuable one, because that will be our business model, just to own by ourselves. So it was our team decision. If you want, you can trade by yourself, but as a team, as a company, we don't do it.
Yeah. So another thing that we tried, just real quick, is kind of a.
Should we turn it? It's behind you, the bottom, all the way at the bottom.
No,
No?
the buttons, the ones above, yeah.
Okay.
I think you can let it go.
So in 10 minutes, that's closed.
Yeah. Just turn the light back and
Yeah. So. Very slow. Okay. Yeah.
What else could go wrong? And there's only one fire exit from this room.
Okay. Yeah. So basically, the second thing that we've tried, for example, is like going for low correlation. That is also something in any kind of portfolio risk management, where you would try to diversify your money across a lot of assets that are at best very uncorrelated. To basically make up like if one asset totally crashes, there are others that are totally unaffected by that optimally, and that would like equal out to some degree your portfolio value. So yeah, what we did here was like to go over all of our projects. It's like 1,100 plus projects, and try to correlate everything against Ethereum and Bitcoin. Basically to try to find like something that is very low correlated with the market, and then yes.
Sorry, what you call project is a GitHub project? Or?
Project is basically like our term for every
asset for any asset, Bitcoin, Ethereum, Santiment.
Cryptocurrencies, basically. Sorry. And go through everything like after a filtering process of again looking for like some liquidity, some market cap, and then investing in the low correlated ones, which in theory should lead to some very rather stable project, like some rather stable portfolio, but in reality, like this thing just exploded. This is like blue is our portfolio, green is Ethereum, orange is Bitcoin. So it just did the complete opposite. It just goes haywire for some reason, which is also like this as a comparison is basically a random selection for the portfolio, which moves very close to the benchmarks. And here, interestingly, we're going for high correlation with Ethereum and Bitcoin, and it also performs not so bad actually. Again, like in combination with some kind of strategic exit, like some moving averages or something like that, or moving into stable coins, this could be quite profitable actually if it moves stronger. But the overall result here was interestingly like something like low correlated stable portfolios actually do not exist in crypto so far. So yeah.
there is no way out.
Yeah. That's
So just understand.
Yeah.
What does it mean when the graph goes high and when it's low? What?
Well, basically, this is like the combination of 20 projects, 20 cryptocurrencies that we selected basically based on the correlation to Bitcoin and Ethereum. So we want to have something that's low correlated. So the idea is basically after the drop at the beginning of 2018, the idea would to have some kind of asset that goes down at least slower because these things are not so affected. And it should not, go down as hard. In reality, it does the exact opposite for some reason. I mean, it kind of makes sense that during the bull market, basically, you would like everything that moves different from Bitcoin is an interesting asset. So these kind of coins actually just skyrocketed. So there's definitely an interesting explanation in there, but it's like for us, the main result was like does not work that easy at least.
Is this
I mean-
effective? I mean, do you recalculate the currencies that you are using, or?
Yeah, oh yeah, sure. Sorry, this is basically done monthly. The idea was here, like for every month, we go through it, select based on the previous month. As I said, like you don't want to look ahead into the future. So, beginning of each month, you want to look on the previous month, and based on those correlations, you select new coins, basically. So it's rebalancing basically monthly to make it more,
So what's the correlation window?
Sorry?
What's the window? How broad is the window? How wide? Correlation.
Extend.
Like I actually had the picture. Yeah? Okay, yeah, so it's
Just as a background, when we did it, because in classic finances, there is an assumption that if you diversify a portfolio, you reduce the risk, like volatility and all the things. And now in the crypto, the kind of what we wanted to see with the data, it's the thing is there is only one risk, or there is only one fight in crypto. It's like old economy against crypto, and it's basically cash, stable coin, let's call it, against whatever happening in the crypto. This is only actually thing you need to take care if you want to measure, or let's say to adjust your risk parameters of volatility. You only consider how much I keep in the cash stable stuff and how much I keep in crypto, because crypto by itself is so volatile, so risky. There is no way you can reduce risk inside the crypto. It is and will stay for some time as risky as you see in the chart. Nothing can be changed. So now there is a proof. So there is no need to be in an illusion. This is a reality, crypto reality. Risk is there, and it's a huge risk.
Okay, so just a few things on the common mistakes or the common pitfalls that you have, like when doing backtests. There are some things that you need to look out for, and generally, it's you need to think of backtests as like in statistics you say all models are wrong, but some are useful, and that goes for backtests definitely, because in general, like backtests will the reality of how much you make will probably definitely be lower than the one that your backtest predicts because of several reasons. But it generally is like a great first estimate without actually using any of your money. So there's some things, like I mentioned, the look ahead bias, where you basically need to be careful that you do not use data that you at this point of time should not have. Something like a survivorship bias, where you basically say, our database already just contains the survivors, like the cryptocurrencies that made it to a certain degree, and only using that already excludes like the ones you could have invested in that totally went downhill. And of course, like some stuff like transaction costs, bad market impact, slippage, all that stuff that's happening when you do actual trading. You can include that in backtests, but you also definitely need to be aware of it. Okay, so yeah, basically, pros, it's a great way of doing like a first look at any kind of strategy. You can very fast test a lot of strategies. You can basically like come up with everything you want and then see like what performs well. And if it performs well, you can try it on different data to have like a more or less independent sample. Comments are like that. It's actually right now I think very difficult to find a good framework. There are these pitfalls that I mentioned, and like the kind of danger of having too unrealistic expectations because backtest might actually,
And how do you take slippage into account in your backtesting model? Is it based on experience, or how do you do it?
This currently we don't do it at all. This is just for scientific purposes, so it makes sense to just ignore that. But you can actually do it. Like there are the previous like some frameworks do it in some way. Like it's typically nothing too complex. Like transaction fees, you can just add and all that. So, but you have to make some assumptions. You can't.
It's like adding to every trade 0.2% of transaction fee.
Transaction fee depends. Like in Binance, it's like 0.3%, I think right now. So it's not that big, but.
Can you also short cryptocurrencies in your backtesting?
Sorry?
Can you also short them in your backtesting?
In this, like in my module right now, not yet, but it's just a matter of who you want it. It's not that difficult to implement.
It's a good stage of the market. People asking about shorting. Finally,
Yeah. Makes sense.
it's by itself a good indicator where we are. Actually, the last few weeks it was here.
Okay. So, and here's like an example for the Excel spreadsheet that we're working on. No, not Excel, Google Sheets. So yeah.
There's a question, what is the difference between Google Sheets and Excel?
It's just the producer, like Excel is Microsoft, and it does its own thing, and it's free actually. So in some way, definitely better than Microsoft. Yeah, so we've done this already. You can use this kind of whatever it's called.
QR code.
Yeah, QR code. If you want to get a link to our preview beta, it's live already. You can basically like download very easily, like simple download, like a lot of projects. We have like 1,300 cryptocurrencies right now. Not so many metrics as of right now because it's just the first version, like first beta version. But you can, like, if you want, you can try it out, and it's going to be published in the near future.
And if you find very nice strategy, let us know. We'll
Yeah,
share it, or you can benefit from it.
Yeah, problem. Okay, cool. Thank you.
Yeah. Do you have? Well, we will have.